Well, good evening, and welcome to another Capital Market Review. Happy Tuesday. Today's presentation is going to look a lot like last quarter's presentation. I do want to talk about a couple of subtle changes and also talk about maybe a little bit about the election from the standpoint of historically, what does that mean if we have a Democratic president, Republican House, vice versa. It's kind of interesting. Perhaps it surprised me as to what the numbers kind of look like. Every presentation I come up with a theme, and this theme is exactly the same as last quarter, uncertain times. Clearly, if you were to just base your investment theme on headline news, there's ample things to worry about, ample risks. And over the last couple of quarters, we've gone from pessimism to optimism, which was the first quarter of the year when the market was up over 11% in the quarter, to pessimism again, which is where we left it last quarter at the end of June. At that point, we started to see a bit of a pullback from April to about the middle of June, and then slight recovery, but the returns for the quarter were pretty negative. And then in and around the middle of June, we started to get hints of quantitative easing part 3, and the markets reacted positively to that, and we are back to some degree with optimism. As today is Tuesday, we have certainly witnessed the last 3 weeks. We've had a little bit of a pullback. Market, I think, got a bit ahead of itself, and we're at a point now where we've had some degree of pullback, nothing substantial, and valuations, frankly, are a bit better. Why do we do this? Well, one of the reasons is I think it's a good idea to dissect the major components that are out there in terms of the economy, growth rates, job creation, profits, inflation, interest rates, because it gives you a little bit better idea as to what I see in terms of the data. I kind of let the data lead a lot of our repositioning and allocations. It also allows me to maybe take a step back and say I'm not exactly as worried as headline news for this reason or that reason. But more importantly, if we start to see a breakdown and those things are reflected in economic data, we might be able to take action where the industry may still be very positive, as was typically the case during the dot-com bubble burst and well into the credit crisis. Economic data started breaking down in 2007, but a lot of the investment themes were still very positive. So by analyzing this, hopefully it gives us a bit of an idea as to not only where we are in terms of right now, but hopefully where we're heading. And with that, we might be able to either position properly to take advantage or to provide some. All of this is my attempt to allow everybody to stay balanced, stay diversified. I'm a huge fan of that. And more importantly, stay invested. When we start making investment decisions, get in and out of the market based on the ebbs and flows of the news, inevitably it leads to very poor investment performance. And the idea is once we're invested, we want to stay invested, obviously trim the sails and make adjustments, but don't feel we're vulnerable to these big swings by getting in or out. Nobody has successfully been able to time the market, and I certainly am not going to claim to be able to do that either. The 4 themes we want to talk about this quarter are as follows. First theme is investors behaving badly. Second theme is U.S. equity markets still look attractive, at least from a valuation point of view, and we'll talk about that. Global markets are clearly troubled, no doubt about that. But we're not in crisis mode as most folks would be led to believe. And the final theme is, once again, best advice is always stay balanced, and we'll shed some light on that as well. So before we get into the agenda, let's just take a moment and see where we are. Well, this chart's very interesting. This was the high 5 years ago. Last week, October 9th, the S&P hit a high of 1565. We're at about 1441 as of the end of September. We may be just a bit above that today because the market's been strong in the last 2 days. And we've gained about 113% from those lows that we experienced in March of 2009. If you look at the chart, you can see that we're still not, after 5 years into this recovery, back to the levels that we were at in 2007. The S&P is still 8 or 9% below that. One point I'll make now, and I'll make it again, I'll repeat myself, is people are saying, well, this market's getting frothy, we're 100 and some % above the bottom, maybe this is over or close to being over. Here's the big difference. 5 years ago, when we hit 1565, forward-looking PEs on the S&P 500 were at 15.2 or 15 times earnings. A stock that has $10 in earnings would trade at $150. Today, that's about 12.9 or $129. We still are not as rich in terms of valuation as we were. And we'll talk a bit more about that and look at a few more metrics later on. Another thing about the rally so far, and I don't know if it's the fact that people have felt that they've been away from the market and are running in droves or trying to attempt to play catch-up, which is never a good idea. But this is a lower quality risk-on rally. And what I mean by that is in risk-on rallies, generally the areas that perform best are those areas that are deemed to be a bit more speculative, carry with it a bit more risk. As an example, while the S&P through June was up 16, it's up about 13 and some change at this moment, or at least as of Friday. You can see that things like telecom up 25, discretionary, consumer discretionaries, items that are non-durable that you don't have to go out and buy, are up over 20. Technology up over 21. Financials up over 21. And yet the more conservative core items like energy up 7, or utilities up 4. Those that are deemed more risky performing better than those that are less risky or more conservative. Stock valuations still reasonably cheap in spite of the run-up that we've had over the last year and certainly the last quarter or so. P's are 12 and some change compared to 10.8 a year ago, so things are a bit more expensive than they were then, but still significant discount to where they are over a rolling 10 or 15-year average. And valuations are still reasonable. PEs today are still typically beneath historic PEs in a number of categories. We're going to look at this chart one more time and actually look a bit more closely at what that means from the standpoint of whether we're overbought or oversold, whether we're expensive or cheap. Let's talk about our first theme tonight, investors behaving badly. I chose this theme primarily because, and this happens so often, when we look at the markets and we look at the way the public reacts to either news flow or reacts to the market at any given point in time, generally the public has the propensity to do just the wrong thing at the wrong time. People buy when the market's expensive and people are talking about how much money they've made. We're more willing to put more money in the market that's high and expensive, and yet when things are cheap to invest in because they are so cheap, we shy away from the market. And we're experiencing some of that data today, and it's very clear when we look at the information as of the end of the quarter. As of right now, we are abundant in cash. In total, in our economy, we have over $10 trillion in cash. And from a historical point of view, household cash is relatively high. Not as high as when we were in panic mode, but frankly, as high as it's been the last couple of years, and significantly higher, or as high as it's been the last decade. There's an awful lot of cash in the system. Markets are where they are today. PEs are still low, but we have a boatload more cash today than we did, let's say, in 2007 when we put that high in. That cash certainly can fuel additional expansion. And obviously, as we know, income being generated off of cash, or in this case, a 6-month CD, is about as low as it's been in recorded history. This chart goes back to 1986. It's 26 years, and yet the chart tells the story. We've never been this low in history. People tend to buy when they should be selling. People tend to sell when they should be buying. If you look today at the amount of money being put into funds and ETFs, investments, and you divide that out between that that's going into stocks and that that's going into fixed income, the amount of money going into fixed income dramatically greater than the amount of money going into stocks. In fact, this chart here kind of shows that. Above the line suggests that bond or equity flows are exceeding bond flows. Below the line, money is going into bonds over money going into stocks, and this is the incremental amount. So frankly, through August, most recent data available, $51 billion more money went in the bonds than equities. And what's interesting about that is the equity market over the last rolling 3-year period, even though 2011 wasn't terrific, 2009, 2010, and so far 2012, the returns on the equity market vastly superior to the returns on the broad-based fixed income market. Consumer confidence still kind of weak. It's been improving the last couple of quarters, but it's still kind of underperforming, and that's important because generally market tops are put in usually when valuations, especially confidence numbers, exceed the average and exceed the average by quite a bit. Here is the dot-com bubble burst ending in 2000. Here is kind of where we were in 2007 before the end of the period, and we started really seeing in 2007 a deceleration in economic data, which we really don't see at this point. You'll see that in a minute. So from that point of view, as things begin to improve, we still could see some improvement with respect to the markets as well. We talked about fund flow, and I mentioned this chart down here. If we look at this chart here, literally we've had money pouring out of domestic equities every single year, just about every single quarter, and at the same time money going into individual bond funds over the same time. And we're buying bond funds at historic lows. So investors are willing to put money into bonds where, as of the end of September, a 30-year Treasury is priced to yield 2.82%. When you factor inflation in before taxes, they're willing to buy bonds where they have no hope of earning anything in terms of real return. That's a fear trade, and there's a tremendous amount of fear in the marketplace. When we look at returns, year-to-date on Treasuries and fourth quarter, and year-to-date on most bond funds, with the exception of high yield or emerging market debt, returns on most of the domestic stuff where all this flow is going certainly pales in comparison to the equity market. And part of that's important because of the impact of interest rates and bond values. And we'll touch on that in a moment. Here we are. This is a chart of 10-year Treasuries. 10-year Treasuries peaked in 1981. You could literally lock in a 10-year Treasury bond at 15.84%. And as exciting as that number sounds, as attractive as that number sounds, the reality of it is many people didn't take advantage of that. Why? Because money markets were paying 21%, and everybody thought these rates are just going to continue to go up. And instead, they opted for a short-term, higher return. But boy, those numbers came down quickly, as did these numbers. So imagine, on a 10-year bond, you would have earned $15,840 per $100,000. Today, you're earning in many cases less than $8,000. That's a huge reduction in purchasing power. And today, as I said, that same bond is paying 1.65 or $1,600 on a $100,000 bond. And the real return, inflation adjusted, is actually negative. And yet money is pouring into this when, as I said before, interest rates are historic lows. Why that's important is at some point interest rates are going to rise. And this chart here indicates the amount of return or loss per every 1% decrease or increase in interest rates. So as an example, if interest rates were to rise by 1%, this gray bar, a 10-year bond would lose 9% of its value. If interest rates were to rise by 2%, that's almost a 20% loss. In a 20 or 30-year bond, it's for every 1% rise in interest rates, there's a 20% drop in value. And you can see how that's with Treasuries, and you can see how that impacts other asset classes, TIPS, munis, corporate bonds, high yield, mortgage-backed securities, a bit different. So when interest rates do rise, bonds are going to suffer. How the bond section of the portfolio is allocated will determine the sensitivity to rising interest rates. But in spite of all that, money is still flowing there. Once again, investors behaving badly. Second point or theme, U.S. equity markets still look attractive. We saw this chart earlier from the standpoint of PE. And when we look at it and we compare it to long-term returns, 10-year, 15-year, we notice that it's reasonably cheap. Price to book, still reasonable. Price to cash flow, still pretty cheap. Price to sales, pretty reasonable. Peg rate, a bit rich. Dividend yield is still very high compared to historic. So to that extent, markets are still reasonably cheap. When you look at PEs and you adjust those PEs to cyclicalities in the market, and you're doing adjusted trailing 10-year earnings, this is the Shiller Index, the same guy that does the Case-Shiller Real Estate Index. PEs are not by any means expensive. They're at best kind of long-term trending. When you look at the comparison of S&P earnings relative to investment-grade bond yield, there's still a significant spread. The rule of thumb is when the S&P yield, which is this green line, is above investment-grade bond yield, which is the blue line, and there's some degree of spread, stocks are still very cheap. if that were to converge, they're probably fully valued. And if they were to spread in an opposite direction, like here, where bond yields are significantly higher than the earnings yield, the markets are very toppy. We're a long way from there. By the way, this point, which for illustration clearly shows that example, the year 2000. Again, January, the market peaked. That was the beginning of the dot-com bubble burst. Earnings are still fairly cheap. A couple things about earnings. This quarter that's being reported now, you're going to see fairly flat earnings. In fact, it may be slightly negative when the earnings actually come out. Expectation is they're going to be somewhere between $108 to about $111 in earnings. And that shouldn't worry folk because PEs are still very low. If some of the news cycle, some of the unknowns that are out there become knowns, be it the election, be it the European problem, be it the fiscal cliff, then I think the PEs, which are clearly suppressed and are trading at a discount to historic, could actually rise. So you could have a situation where even though earnings aren't growing, PEs are expanding and prices are going up. In fact, in some cases, if some of the unknowns clear up and PEs expand, earnings could actually detail off here a bit, and yet prices would still rise because of the expanding PE. If that's the case, we just have to be cognizant of average, and once we get above average, we need to signal the fact that, hey, things are getting kind of pricey. Today, large cap growth is about a 28% discount to historic PE. Last quarter, when I reported to you the same chart, it was about 35%. So the rise in the market here has reduced the discount somewhat, but today you're still buying large cap growth at about a 28% discount to historic PE. Also, that's the cheapest area in the market, and conversely, small cap value has a very slight discount. Current PE is very close to historic. So as we move up in terms of equity size, and we move over from value to growth, we are finding greater value from the standpoint of lower price. One other thing to discuss here is when we look at the individual categories, financials, technology, healthcare, energy, etc., and we look at forward-looking PEs, and we compare those to historic PEs in their respective category, the only one that jumps out as being a bit pricey would be utilities. And utilities have enjoyed a huge rally, especially because of the uncertainty. And as a result, when you look at current PE to average 15, forward PE or trailing PE to 20-year, you look at dividend yield is not far off the historic mark. That's the only category that one might say, look, that's kind of pricey. Usually at market tops, you see an awful lot of those. Telecom, which is also a utility type security, is also probably very pricey. When you look at forward PE to historic, trailing PE to historic, and dividend yield is the only thing that still looks attractive. But beyond that, everything else seems fairly reasonable, and that's important because usually out of those 10 categories, you'll see the bulk, 8 or so, become very expensive at market tops. We talked about the PEs being lower now than they were at the previous peak. We talked about the fact that the current market is still 8 or 9% below the previous peak. If we look at dividend yield today, on average, is 2.1 on the S&P. 10 years ago, it was 1.1, and at the previous peak, October 2007, is 1.8. Treasuries are now 1.6. They were 4.7 and 6.2 over 10 years ago. So when you look at yield today, yield is substantially higher than where the Treasuries are. And one would conclude that dividend yields could come down significantly because U.S. Treasuries are so low, and there's still quite a bit of value in the overall market. From a bull market point of view, lengthwise, here's where we are in terms of number of months of length and in terms of price appreciation, and there's the average. So we're about halfway from an average length and maybe 2/3 of the way from average performance. So by no means is this market long in the tooth. Could it expand? It could. Could it stop today? It could, but it's not as if this is an overextended market from either appreciation or timing. One thing that is changing, and we've seen this the last couple of quarters, is the component of earnings that are being reported. Early on in the recovery, when we started to see positive earnings, the bulk of that came from improvement in margin. Margins improved, efficiencies were robust. In part of that was they were starting out with companies that had restructured, laid off, cut divisions, very lean and mean. So a lot of the improvement came as a result of margin. As margins come down, which is very natural, we started to see revenue share increase. And that's just the fact that they were selling more widgets. The demand had improved. And obviously, because of the European problem, it slowed their economies down. They're hovering at flat line to slight recession. The Asian markets have slowed down as well. Our market is really the only main market that is performing and growing at a positive or by a slow rate. That being said, revenue share has come down a bit. Demand has come down a bit. And that's one of the reasons that earnings are beginning to level off. But that could also change if we see a reacceleration here of demand. And some economists are expecting next year's GDP maybe closer to 3%. So these earnings, might not necessarily roll over. They may be flat and then improve, or they could at least possibly. Confidence in capital markets. We showed a chart before about consumer confidence. The one thing we need to understand is confidence generally is fairly low right now. PEs are extremely low, and what generally happens is as confidence starts to rise, you get an expansion in PE as well. We saw that here. If we look at the 90s, consumer confidence increased substantially here, and PEs went up as well. So the multiples went from 12 to 13 to 14 to 17 times earnings. This could happen, and this would be a multiple that would be applied to earnings and could cause the markets to go higher. Obviously, if confidence were to drop off, we may very well see PEs drop off as well. And the other thing, and I mentioned this before, this is another way of looking at it, confidence to dividend yield. What's kind of interesting here is, confidence is beginning to increase, although generally interest rates have been dropping, and that's not very natural. They tend to work in the same direction, or directionally at least. They're linked. I think part of that is what we're seeing here is the influx of a couple of quantitative easings. So interest rates, to some degree, are artificially low, and at some point they will snap back. There's a lot of talk of a fear of another big recession, or another big recession right now. I don't see it because we clearly don't have the degree of leverage we had in 2007 that we had to unwind. And the other thing is a lot of the big industries that generally create a lot of jobs and use a lot of leverage we're not seeing significant improvement in demand. We're not seeing an overabundance in demand. Light vehicle sales are still beneath average. They certainly haven't exceeded average. This is not by any means a frothy market. And slowly but surely, housing starts are beginning to improve, but they're significantly below where they are. And the thought is if they get back to average, which is 1.3 million new households being created as opposed to 750,000, that's something like 900,000 to 1 million jobs. That certainly will boost confidence. And we're also seeing, real capital goods, that's non-defense capital goods, those numbers are not appreciably frothy. We sort of got to the break-even or average line and it dipped below a little bit. That's this low sales number that was also reflected, back in this previous chart here. So none of these numbers are overly frothy that would cause a problem. Let's talk for a minute about the election. I know we have a big debate coming up this evening. Here in Michigan, we also have the Tigers playing the Yankees, so I don't know where your allegiance lies. I figure if anything exciting happens with the debates, I can certainly see it over and over and over again tomorrow, so I may watch the Tigers, or maybe I'll flip back and forth. But anyway, there's been a lot of talk as to, what happens with respect to this election. A couple of things which are kind of interesting, and I think it has more to do, or less to do, I guess, with who wins the election, but what the balance of power looks like between the presidency and Congress. If we look at, as an example, this is annual returns by political party, and this goes back to 1937 through 2011. So that's post Great Depression, because there was an awful lot of stimulus, and that was kind of a screwy period of time. But if we look at this, since then, if you have a Republican president and a split House, either one or the other, Democrat and Republican, and there were 30 of those, the returns are about 6.5% per annum. And that's pretty poor relative to the other choices. If it's all Democratic, it's about 10. If it's all Republican, 17.4. And if we have a Democratic president with a split, it's about 15.4. So, we've had, since the market bottom, this recovery kind of under a Democrat that started out with complete Democratic and then split, and performance has been okay. If that were to continue, it would be okay. If the Republican wins and power changes in the Senate, could it be a bit better? Marginally, but it doesn't look disastrous either. So for what that's worth, from a personal point of view, I would certainly think that if the Republican won, I think small business folks would feel a little bit more confident that something would be done with Obamacare, something might be done with respect to the tax increase, and as a result, confidence would improve, and maybe hiring would improve. I know as a small business person that employs 10 people, I could hire another professional staffer, and I'm doing without until I have some idea of what effect this has on my taxes, what effect it has on corporate taxes, and what effect it has on the benefits I pay. I pay fairly rich benefits, and I understand I'm going to pay a penalty because my health care benefit is too rich. It doesn't make a lot of sense, and as a result, a lot of folks are sitting on their hands. So we'll certainly see what happens there. Let's talk about the European issue, which is problematic, but it's not crisis. And in fact, the central bank has done quite a bit to alleviate some of the stress already. Their big problem stems from this chart here. In the U.S., we have a central bank, and we have regional Federal Reserve banks. And the regional Federal Reserve banks can move capital into areas of the economy that we need it most. If we need help in the Midwest, we can move money via the Federal Reserve system. If the Northwest is doing phenomenally well, capital there can be moved back to the Federal Reserve that can be redeployed. With the EU, they lack that kind of fiscal mechanism. Very, very difficult to do. So they kind of cobble a solution, but as a result, it needs the approval and ratification of each one of these countries. And generally, the Northern European countries aren't too keen about bailing out the Southern European countries. You know, if you think about it, we have essentially a two-party system, and it's very difficult for us to agree on anything either. Witness the credit crisis or the fiscal shelf or cliff, depending on how you feel. That's two parties. Imagine 16 different finance ministers reporting to 16 different parliaments or cabinets. Very, very difficult. That being said, they have made some improvements. They created something that looked like a TARP program. They realized that when we bailed the banks out here and created the stimulus and required our banks to write down reserves, the Europeans didn't do so in the same manner. And as a result, 3 years into the recovery, it's coming back to haunt them, to bite them effectively. And they now have to do some real serious write-down and, frankly, real serious stimulus. And they're beginning to do that. And we can see that to this extent. Interest rates are really starting to come down. Prior to the beginning of this year, interest rates really started to go back up, especially in Portugal and Ireland, and to some degree Spain and Italy. And the thought was nothing's going to get done. The EU is going to break apart, and as a result, these companies are certainly going to leave the European Union. They've since flooded the market, moved capital, requiring some of these banks to write down. There will be some degree of restructuring. There may be with Spain. But as a result of those actions, interest rates since the beginning of this year, actually since the fall of last year, have come down significantly. The risk premium has come down. The risk of an outright default and loss have come down. So the Europeans are doing the right things, arguably. They're not doing it as quick as anybody would like. But the benefit there is this. Markets, and this is one of the reasons that you can't make investment decisions based on headline news. If we wait until things are rosy, we've missed the market. If we react to negative news, effectively it's been priced in and it'll move quicker than you can move. So right now the market is trading at a discount to PE, one can argue. And one of the reasons for that is headline news. So one could think of the market as perhaps pricing in worst case scenario in a lot of these issues, the election, the European solution, the fiscal cliff, etc. And if those things don't come to fruition, don't come to failure, some sense of failure, then the thought is, you know, things aren't quite as bad as we thought. And as a result, the markets tend to move up. One economist, David Kelly, terrific guy, can explain complicated issues very easily, said, you know, the market is a lot like a roller coaster. When it's going up, it's all quiet. But when it goes down, there's an awful lot of screaming involved. And that's generally what's happening right now. As these things get fixed, the markets gradually go up because the expectation is failure and we're either kicking the can down the road or slowly solving the problem. As far as valuations, Europe really is beginning to look cheap. Might be a little scary to invest right now, but cheap. Good quality, multinational European brands look really pretty cheap. And we're beginning to look at that. At this point, we've been really underweight the European market, and we're looking at maybe starting in some of our discretionary portfolios to start adding some exposure there, or a little bit more exposure. And this chart kind of helps explain why. The gray bar in each country's case indicates the range, standard deviation move from its average of how expensive or cheap the market is relative to its historic average, and also relative to the world. So as a result, Japan has traveled in this type of range. The brown bar, I guess it is, that brown hash mark is its average, standard deviation from global average. And the diamond that we see right here indicates the current valuation, or where we are right now. So as an example, Switzerland is fairly much priced fairly close to its historic average. Not what I would call cheap, certainly not expensive either. Conversely, the Europe, Australia, Far East Index, the EFI, is fairly inexpensive, at the low end of its historic range. France, at the low end of its historic range. World Index, including US, low end of its historic range, probably a little bit more fully valued than the EFI. Japan, real cheap. Germany, pretty fully valued. Canada, pretty cheap. And here's where the US is. That's one of the reasons that World is moved up a bit from here because of the addition of the US market. But generally pretty cheap. You're buying Ps that are single digit, low double digit, some that look like the US, but some that are cheaper than the US. Emerging markets, a little bit different story. Same scenario, charts mean the same thing. Really expensive, Korea. Fully valued, Brazil, Taiwan. Mexico's not cheap at all. India is not super cheap either. China is cheap. Russia is cheap only because a lot of people don't feel comfortable investing in Russia because of the political situation there. But not quite as cheap. Ps range in Russia's case of 5, China's case of 9 to mid-teens. So what's the best advice? As it is typically always, best advice is to stay balanced. Now this chart, which is brought to us by our friends at JP Morgan, added another asset class this quarter, and that was cash. Cash was never considered an asset class in terms of this Kaydan chart. And you can see historically, cash is not the best place to be. So how we read this is each column vertically represents a year. We go from highest performance at the top to lowest performance at the bottom in that given year. This is cumulative for the year, or cumulative over the 10-year. This is annualized. This is the fourth quarter and year-to-date, and then the previous 10 years. Cash, low, low, second low, 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 low. Worst possible returns. The exception is when all heck breaks out. 2008, 1.8% was the second best performing. The point is, if we had a balanced portfolio, which we typically run, this gray or light blue, I guess it is, represents a balanced account. You'll see it never hits home runs. It kind of arcs its way through the mid to upper mid-range point. And you'll see in no case was the performance ever the first, second, or third best. However, when you look at the long-term performance, because you don't give up as much in a bad year, you don't make as much in a good year, but directionally you're moving in the same direction, the cumulative performance was the third best. It outperformed bonds, it outperformed small cap, it outperformed market neutral, it outperformed the EFI, which is European commodities, it boldly outperformed the S&P, and it significantly outperformed cash, both cumulative and annualized. So by not giving it all back and having some degree of balance in the portfolio, it certainly makes some sense. And we can see that here. This portfolio, which is 70-30 stocks and bonds, bulk of the stock would be U.S. versus international, versus this portfolio, which is about 26% bonds, 4% emerging market bonds, so it's still bonds, and then the 70% equity is allocated between commodities and other aspects of the marketplace. Returns slightly better, standard deviation slightly better. So as a result, by diversifying, we not only reduce some degree of risk, we can improve the return a little bit as well. Annualized returns by asset class, not really that important other than this very last point here. For a 20-year annualized period, 1992 to 2011, homes now have fallen to one of the worst performing areas. That's encouraging from the standpoint maybe it starts to pick up from there. But the average investor has typically underperformed every single investment category. And part of that reverts back to investors behaving badly. We buy high, we sell in panic low, we tend to get out of things that have underperformed just before they take off, and we buy things that look like they performed well just before they roll over. As a result, investors have even underperformed homes, although they own homes. One of the reasons is they probably traded up and bought a big home in 2006 or 2007 just before things rolled over. One other point about diversity is also length of time. You know, when we talk to clients about performance and we talk about allocation, it's important to really match what the account needs to do with the length of time we expect it to do something. You know, recently I've had conversations with a number of clients because of the GM pension lump sum rollover, and we were very stingy in recommending rollover. In many cases we recommended stay the course. But in the cases where we did recommend rollover, it was primarily because of this chart here, which is a 20-year rolling number. So the way this reads is green is stocks, blue is bonds, and the whatever color that is, purple I guess, is a balanced portfolio of 50-50. Now we can argue whether balance is 50-50, 60-40, 40-60, but generally it's balanced, half or nearly half stock and bond. And you can see if we're talking about a one-year horizon and we're all fixated by the lousy couple of years, we can see, well, geez, you know, these things could be down significantly any one given year. And they could also be up, but we focus on what the downside looks like. But when we're talking about pension-type dollars, and we're now looking at 20-year periods, and by the way, this is a rolling 20-year period from 1950 to 2011. That's a 61-year period. I don't know how many rolling experiences that is, but it's significant. For that 50-50 portfolio, the average return was about 8.9. The best was 14. Imagine a 20-year period of time where you averaged 14%. But the most important thing is the very worst case was 5. On a balanced portfolio, as bad as it got, the very worst 20-year period experience was 5%. And those folks who we recommended lump sum, in many cases when adding other assets, the distribution rate was significantly less than 5. In fact, you can see that a balanced portfolio, in this case, outperformed bonds. Over a 10-year period, it outperformed bonds from the downside. In a 5-year period, 5-year rolling periods, there was more consistency in a balanced account than a pure bond portfolio. The only time that gets kind of messed up is when we talk about short-term duration. And why it's important to focus long-term, any given year, whether the account's up, down, or sideways, you will have drawdowns. You'll have periods of time, months of time within a calendar year where the markets can be down. This chart illustrates that. The bar represents the performance in any one of these calendar years. For example, 1996 was a 20% return. The purple dot underneath represents the inter-year drawdown, or the correction during that year. So here there was an 8% pullback. We ended the year up 20%. Here, 2 summers ago, there was a 16% pullback during the Greek problem, and we finished up 13. In 2009, the first quarter of the year was down nearly 30%. We recovered all of that and added another 23% to finish up 23. So drawdowns are part of the market. The average drawdown is about 14.5%. So with that, let me answer a few questions and see if I can answer a few of these. One client wanted me to go back and look at that chart about the presidential elections, and he said slide number 30, Republican president, and split is the worst. Really, it has been, and typically was. If you consider the relative performance under Bush 2, Bush 1, where you had a split house, it doesn't seem like it. I think the exception to that rule may very well have been Ronald Reagan, but prior to that, every Republican president with a split house has had some difficulties. In fact, remember that was a big deal when Tip O'Neill kind of met eye to eye with Reagan, and they kind of pushed through some reform, which really kind of helped and kind of got the economy rolling again. What's encouraging is this scenario, a sweep, as well as this scenario where you have a split, some degree of gridlock with a Democratic president, both work. And I think the expectation is the results of this election are going to be one or the other. I don't think the expectation is this. I don't think the House goes that way, and I think there's better than even odds that the Senate and the House may actually go Republican. So that's at least encouraging. Obviously, there's some short-term issues that we have to deal with, but I don't think anybody believes that there won't be some horse trading done with respect to taxes, and we don't think we'll see a, and that we won't, and I don't think people expect that we'll have the severity of the cliff as it is expected to happen currently. Another question is, what about real estate as a good investment under current conditions? I think if you're a buyer from the standpoint of owning a home, homes have probably never been more affordable. In fact, it's frankly cheaper, and I don't have that slide this quarter, but I usually mention it. It's actually cheaper to buy a home, to a national average, and cover the mortgage than it is to rent a comparable home. It's cheaper to own than to rent. And whenever that happens, that generally signals that the residential real estate is fairly cheap and affordable. That certainly makes sense. From the standpoint of commercial property, economy is still very weak. There was a tremendous amount of overbuild from the standpoint of retail space. In fact, that's a big problem right now. Some of the larger architectural firms that focused on big major malls have had many projects cut back, and a lot of old malls are kind of retooling, and the expectation is we have way more retail square footage. Looking at other types of commercial real estate, medical real estate looks very, very strong. Companies that are involved in building and managing medical use real estate still looks very, very attractive. And I try to practice what I preach. My wife and I are not serious, but we are beginning to look at some vacation slash retirement property. Like I'm not going to retire anytime soon, but we always thought about having at least one home on Lake Michigan. And while prices there certainly haven't come down as much as we would have liked, we think from an affordability point of view, it makes some sense. So we're beginning to noodle around, and we talked about it for 10 years, and we're just now beginning to take some action. So yeah, I do think real estate looks fairly attractive. Another question is, regardless of who the president will be next year, there is an urge to get out of the market and into cash. Is there any insurance that the investments are on the right track? Other than performance, when you look at the account and look at account performance over the last couple of years, performance has done very well. From that point of view, investments are certainly not insured. They're insured against firm failure, but not against volatility. The government has effectively said that no one will earn anything on riskless investments. That's why the Fed funds rate, which is about as safe an investment as you can get, is essentially, from a real return point of view, zero. And the implication there is, if you think about risk as a target, where the risk-free investment is that point in the middle, and then the concentric circles from that middle, as we move to each concentric circle, we take on more risk with the promise of better return. It's a promise. If it were a guarantee of return, it would be a guaranteed return, and that would again be zero. I do think that a diversified portfolio where you have some money spread out among stocks and bonds and commodities and cash and other securities will certainly weather a storm if there were to be a storm. But looking at the areas that we typically are troubled by, the headline news, those aren't the things I think that we need to worry about. The things we need to worry about that, frankly, I can't communicate with you because I don't know what they are. It's the unknowns. It's always the unknown risk that kind of gets us or disturbs the market. And if we were trying to invest for those continuums or those possibilities, the account would look like a zero return portfolio. So there needs to be some degree of exposure to markets. Clearly the markets tend to fool us. They tend to perform better than expected. I think that's kind of what we're beginning to see. I hope that answered your question. One more question. Obviously Obama has bashed Bush for the last 4 years. Do you have any data regarding the lag or overlap of President's monetary policies and its effects? Well, no, I mean, I don't have any data that I can share with you this evening. I will tell you this, that I certainly think that a lot of the data points that comes out of Washington, even the Office of Management and Budget, are certainly suspect. The unemployment numbers that came out a week ago, and some folks were doing backflips because they looked so good, were really warped numbers. If you really looked and defined unemployment as those that are actively seeking employment on a full-time basis, the unemployment rate is as high as it's ever been, probably close to 15%. Shenanigans are certainly being used from the standpoint of let's redefine that definition. If you're looking for work or have certainly secured work, but clearly you're underemployed, you are now deemed employed and are no longer unemployed. So the vast majority of people that are looking for replacement work, replacement career, full-time, and are settling for something else just to get by so they don't go under are considered problem solved. That's a big problem. I think we've got big problems from the standpoint of structure. You can't tax the wealthy enough to solve the problem. At the end of the day, the problem is you've got to be prudent with how we spend money. That includes all programs. And I think the other issue is we certainly have to look at cutting where we can and right-size the government. I think we need to spend money prudently to create jobs, which then create tax revenue, which can afford the opportunity to spend money in areas that are more social in nature. You know, I'm probably not the best judge of this. If I thought there was a shot, I would probably vote for a libertarian. I tend to be pretty fiscally minded. I'm a bit more socially moderate, though. I would love to see an overhaul of the tax system. I think that would certainly help. But those are big fixes, and I don't think that's going to happen anytime real soon. The only thing that I'm hopeful of is if there was a Romney victory and Romney were to listen to the Paul Ryans of the world, I think you would see a much more elegant and efficient tax structure. We deserve it, and boy, from a global perspective, that would make the U.S. look so much more compelling. Well, I think that's it on questions. I want to thank everybody for attending. We'll have another one of these in January. And also next year, we're going to have a few more of these webinars. We have a number of clients that have common portfolios. And one of the things we'll do is reach out to you, invite you to these type of webinars. We can really focus on the specific portfolio you have, changes, where we are, adjustments, why we're in cash, why we're not, what's working, what's not working, and I think that's going to provide a lot of value add. With that in mind, have a great night. Go Tigers. We'll see everybody very soon. And as always, if you have any questions, let me know. Hey, one thing. Next week, I'm actually leaving for a kind of a work/vacation. I'll be out of the country for about 2 weeks. I'll be in India. Sounded like a good idea at the time. My thought now is anytime I've got to leave the country and go somewhere where it requires shots, probably not a good idea. But that being said, my phone's supposed to work. I will have internet access. Staff will certainly be able to get a hold of me. So with that in mind, we need to, if you need to get a hold of me, by all means, please do. And with that, those that are still on the line, make sure you read carefully all the disclosures and risk slides, because the compliance department certainly wants us to put those on the screen and let everybody see those. If you'd like copies of this or the presentation or copies of the definition, risk, and disclosure, give us a call. Thanks so much. Have a wonderful evening. Good night.